Joining us is Chief China Economist at Capital Economics, Mark Williams. Mark, good to talk to you tonight. How concerned should other markets around the world be as to this freefall in China?
I don't think the implications for the rest of the world are actually that great. China's markets are pretty well walled off from the global financial system. China has pretty strong capital controls that limit cross-border investment. And the market in China actually is also pretty well separated from the actual economy in China. So there aren't even that many implications from what we're seeing on the equity market to what's happening in the rest of the economy.
That's an interesting point that you make because, of course, you'd think it would flow onto the broader economy. Most indices would impact, I guess, the companies that the index represents. So why does it have that disconnect from the broader economy?
Well, normally when stock prices go up, one way, or the important way that can affect the economy is people feel richer and they go out and spend more, and then if prices collapse, as they have been doing in China, then they pull back on their spending. In China's case, though, there's a couple of things. One is that a relatively small share of the population owns equities in China, maybe about 1 in 30 people, so it's not that many. And those people are also quite rich, so that they can actually afford to take a bit of a loss. The other point is that the prices went up so fast on the way up that people didn't really have that much time to sort of adapt their spending, if you like. There's certainly no evidence that consumer spending, for example, picked up a lot over the past year when prices were rising. So I don't think we should expect it to slow now that they're falling.
Mark, what kind of intervention might we see from the Chinese government, and would there be some loss of faith if the market keeps collapsing?
Yes, I think that's the big concern for the authorities in China. They've staked quite a lot of their credibility on this market, not just over the past few weeks, but over the past year when they were really cheerleading the rise in prices. And since the prices started to fall in June, they've come out with a range of measures, of promises to buy equities and rules making it harder for people to sell equities. And obviously that worked for a while. The real concern, I think, for the authorities, though, is that these suggestions that maybe they're pulling back on those support measures were enough to see a massive fall in the market today. So that really raises the question of what do they do now, what their strategy is. I think they have no choice, really, but to sort of double down and come in tomorrow with more promises of support.
Yes, and of course it's hard to really assess what sort of correction the market actually does need.
Well, it is. A few weeks ago, I think you could make the case very strongly that prices there were far too high given the fundamentals. That's still true, but to a much lesser degree now. Prices don't look crazily high now in China. But of course, we know from markets elsewhere that when bubbles collapse, prices can very easily go too far in the other direction for a while. So we could potentially see prices come a lot further down. I think that's the concern for policymakers, and that's why they'll come up with something now to try and support the market.
It'll be interesting to watch. Mark Williams, thanks for your insights tonight.
You're welcome.